Good evening. I'm Randy Melzi, Senior Director of Public Policy Programs and Corporate Relations at the America Society and the Council of the Americas. It is my pleasure to welcome all of you to today's book launch, When the Money Runs Out, the End of Western Affluence. I would like to give a special welcome to Stephen King, author of the book, Group Chief Economist and Global Head of Economics and Asset Allocation Research at HSBC. We're very pleased to have Mr. King with us today. His book offers a plain-spoken assessment of where the West stands today. His first book, Losing Control, published in 2010, examined the impact of the emerging nations on Western economic prosperity. Mr. King recently became a member of the Financial Times Economists Forum and is also a member of the UK government's Asia Task Force. He is directly responsible for HSBC's global economic coverage and coordinates the research of HSBC's economists around the world. In 2007, he became a member of the European Central Bank Shadow Council, and he has also written a weekly column for The Independent since 2001. When the Money Runs Out is a fascinating analysis of the complex economic situation of the West, seen through the lens of history under the magnifying glass of psychology and sprinkled liberally with a dose of wit. You say that we don't have enough growth to pay for what we have grown accustomed to, and as societies, we resist the very reforms that will enable growth to return. To illustrate your points, you invoke magic, medicine, and literature. I look forward to reading your next book already. Again, thank you all for being here today. I would also like to welcome everybody tuning in to our webcast, and we look forward to a lively discussion. Stephen will speak for about 15 or 20 minutes, and then we will open for Q&A. I now turn it over to you. Thank you.
Well, thank you very much indeed, and good evening, ladies and gentlemen. It's a great pleasure to be here. People often ask me, why do I write books? And the answer is very simple, that people would often say to me, are you Stephen King, the author? I can now say, yes, I am. It just solves that particular problem. My book is more like a sort of factual horror story rather than a fictional horror story. And it focuses on a very simple theme, really, which is the fact that Western economies, and by that I mean North America, Western Europe, I suppose you might include Australia and other countries in this comparison, Western economies seem to have lost their way. They're not growing at the pace that they used to grow at, in fact, far from it. And if I can give you a little illustration of this story and how it's changed in recent years, I'm going to focus on my country, the UK, or the numbers I'm going to quote here are not really specific to the UK. You will see this story coming through in many countries in the Western world. This is an important year for me for two reasons. The first is that the book is coming out, and the second is that I'm celebrating an important birthday this year. It's not my 30th birthday, and it's not my 40th birthday either. And in case you're wondering, it's not my 60th birthday. It's somewhere in between. And I was thinking, how has the world changed through my life so far? And I thought about this from the point of view of how the UK economy has changed, how the growth rates have changed over this period of time. So in the first decade of my life, there was an increase in living standards of around about 35%. That's from 63 to 73. So it's a pretty big increase in living standards in just 10 years. In the second decade, there was an increase in living standards of about 13%, so a much lower number, but explained primarily because of the impact of the oil shocks in 73 and 79 and the deep global recession that followed shortly thereafter. So perhaps not so surprising that the numbers were that weak. The third decade, an increase in living standards of about 25%. And the fourth decade, which came to an end in 2003, an increase again of over 30%. So these are pretty big increases in living standards decade by decade. Over the last 10 years, that ends this year, the increase in living standards is only 4%. So much, much weaker than anything we've seen in previous decades. And people often say today, is there a risk of entering into a Japan-style lost decade? And my answer is, we've already had one Japan-style lost decade. We simply haven't recognized it. We've already had that in the UK. We've had it to a certain degree in the US. We've had it in many countries across Europe. It was still pretending that we can simply bounce back to the growth rates of old. And what I think is happening here is really something which is associated with Sigmund Freud. And there's a paper that he wrote many years ago called The Future of an Illusion. And that paper focused on his attempt to try to explain why it was that people had very, very firm religious beliefs. He was an atheist, but he couldn't quite understand why people believed in God so strongly, and he had to find some explanation for it. And he felt that religion was an illusion. He defined a belief as an illusion where wish fulfillment played a major role in the formation of the belief. You wanted the thing to be true, and therefore you believed it to be true, but it's only because you wanted it to be true that effectively it was an illusion. And I think that when it comes to the way we examine economies these days, we suffer from the similar kind of illusion. We desperately want growth to come back, so we constantly believe it will come back, and we have all sorts of beliefs about how various magical policies will take us back to the growth rates of old. But in actual fact, those magical policies have not worked particularly well in recent years. I'm thinking here particularly of macroeconomic policies, things like monetary stimulus and fiscal stimulus. And the thing that's worth noting here is that we had a lot of talk about interest rate cuts and quantitative easing and all these kinds of magical things. The reality is we first got hooked on these kinds of stimulus measures, not during the financial crisis, not even the year before the financial crisis, but all the way back in, say, 2000 or 2001. If you look at the period that followed that time, you'll find that interest rates in the US were amazingly low. They were also amazingly low in most of Europe. You'll find there's massive fiscal stimulus between 1999 and 2005. And that was designed to make sure the West would not succumb to a Japanese-style lost decade. And that's exactly what happened. That's exactly what we've been through over the course of the last 10 years. The reason why we have this belief in monetary and fiscal magic is that the alternative, which is of continuously much weaker growth, in a political sense, is much less desirable. Not just because growth is weaker and because living standards aren't rising quite so quickly, but importantly because we made promises to ourselves over the last few years, which were ultimately based on the idea that living standards would rise at a particularly rapid pace. And those promises vary from things like pensions and healthcare and education, through to promises in financial markets, the claims that we make through pieces of paper, like, for example, bonds and stocks, which ultimately are a claim on future living standards. They're a claim that somehow money can be lent and then paid back at some future point as a consequence of continuous rapid economic growth. And what I'd like to argue is that those claims taken together simply do not add up. There's too many of them relative to the income that we're currently producing and likely to produce in the years ahead. And the problem with this story is that we've seen in many occasions in the past disappointment coming through economically, which then leads to disappointment and challenges both politically and socially too. And I wanted to use an example here of Adam Smith, one of the greatest economists ever, who was a Scot, although funnily enough you'll find him on the Bank of England banknotes, but he was a great economist. And he talked hundreds of years ago about three states of society. There was the so-called progressive state, there was the dull state, and then there was the melancholy state. So these were delightful terms which avoided all the kind of technical complications of economists these days. It was just simple: progressive, dull, melancholy. And what he was arguing was that a progressive state of continued economic expansion was a state that would tend to reduce social tensions. And there's a very simple reason for this, which is that if you had everyone's living standards rising, even if the gap between rich and poor was getting bigger, it didn't matter too much because the poor were still enjoying increases in living standards. Whereas in the dull and melancholy states, which effectively are periods either of economic stagnation or contraction, the risk was that one person's gain was always another person's loss. And in that kind of zero-sum world, it became politically much more difficult to generate economic growth. You get caught in a lasting period of stagnation associated with bigger and bigger political and social tensions. And in the book, I look back a long way in history to try to identify some of these earlier periods where economies disappoint, and disappointment leads to social and political difficulties. So the examples go back all the way to 1381, which was the Peasants' Revolt, through to 1789 through to 1791 with the French Revolution, which interestingly, according to de Tocqueville, came after a period of unprecedented gains in economic activity. That the period from 1750 through to 1780 was one really of tremendous French economic success. And it led to the extrapolation of expectations that success would continue. Unfortunately, there were a series of bad harvests at the end of the 1780s. And faced with those bad harvests, there was clearly some degree of economic setback. The question was, who would suffer from the setback? And the nobility said, it's not going to be us. And the clergy said, it won't be us either. And the monarchy said, definitely not us. So the consequence was ultimately, it was a so-called third estate that really suffered. And that, of course, was the trigger, if you like, for all that subsequently followed. I looked also at more recent experience, in particular, two, I think, very interesting 20th century examples. Japan, over the last 20 years, had a relatively easy time with stagnation, largely because its economy entered its lost decades with relatively low levels of income inequality. And the other example is Argentina, which I think is a particularly fascinating example because back in 1900, Argentina was one of the richest countries in the world. If you looked at its growth rate from 1870 to 1900, it had one of the fastest growth rates in the world. By 1900, its per capita incomes were the same as those in Germany, but its growth rate was much faster. So looking at what happened back then, you might have assumed that by the end of the 20th century, Argentina might be twice as rich as Germany. In fact, what we see today is that Germany is twice as rich as Argentina. And what's interesting about Argentina is that during the 20s and 30s, as it bumped into tremendous difficulties associated with the Great Depression and other such problems, Argentina turned its back on the rest of the world. It had a low level of savings, but it was very heavily engaged and dependent on the rest of the world. It became increasingly isolated, short of savings, unable to invest, unable to generate growth. And of course, a lot of the difficulties that Argentina suffered from subsequently political upheaval and financial difficulties, many, many examples of financial crises, are partly associated with those difficult choices made in the 1930s, which ultimately I think were very, very damaging for Argentina's longer-term prospects. So when I look at the Western world today, I worry that those historical examples are possibly relevant to the extent that we have this serious economic setback. There have to be reductions in entitlements, whether it's reductions in entitlements within the financial system or reductions in political entitlements when it comes to healthcare or pensions or education. But we haven't got a narrative as to how to administer those reductions in entitlements. We have no way of doing this. We have an expectation the magic wand can be waved, we can return to rapid periods of economic growth. So what's the answer? Well, the first answer is it's not simply a case of creating more and more stimulus. In fact, even the Federal Reserve, I think, now recognizes that there's talk of tapering by the end of the year. The problem with stimulus is that rather than creating growth, it merely creates financial distortion. It creates financial hope, which becomes increasingly large compared with economic reality, and leads to instability within the financial system. So simply going for macro stimulus doesn't work particularly well. I think there have to be other changes that come through. First of all, I think there has to be major support for continuous free and open trade around the world. The big danger with a situation that we have concurrently is all too easy to go for a world of protectionism and isolationism, which is exactly what Argentina did back in the 1930s. That I think is a very, very worrying trend. Secondly, I think that in international capital markets, there has to be an acceptance. It's not just the debtors who borrow too much who are at fault in terms of international financial crises. It's also the creditors who lent too much. And this is something which is difficult to understand, but I think for the creditor nations around the world, they have what I call a rather Victorian approach to debtors and creditors, namely that debtors should be thrown in jail and creditors should be allowed to get off scot-free. That I think needs to change, because the creditors, by saving too much, by investing too much in assets elsewhere in the world, have themselves contributed to asset price bubbles elsewhere. And by creditors, I'm referring to countries with large current account surpluses. So over the last 10, 15 years, that would certainly include Japan, Germany, China, Saudi Arabia, Russia, all of whom have had these large current account surpluses and contributed to financial bubbles elsewhere in the world. I think there has to be an intergenerational debate. One of the biggest problems in the Western world with this lack of growth is that there's a huge gap that's opened up between the interests of what I call the boomers and the generations below. I'm at the very end of the boomer generation, so in one sense I'm part of a privileged group in society. But the reality is the boomers had it pretty easy. But as the boomers come up for retirement, I fear that increasingly resources in the Western will be focused on things like healthcare and pensions, which is absolutely fine, but at the cost of a lack of investment in education, a lack of investment in infrastructure, all of which will eat away at growth rates over the longer term. And I also think that there's a major problem as a consequence of stagnation associated with trust. And by trust, I mean that trust is the glue that holds societies together, and in particular it is something which allows markets to function really rather well. And with the breakdown of trust, which has certainly happened over the course of the last few years, and I have to admit, within my own industry, the banking industry, is a huge breakdown of trust. I think this is corroding opportunities for entrepreneurial activity, for economic growth, that needs to be tackled in one way or another over the course of the next few years. And then finally, and most importantly, from my own profession's point of view, as an economist rather than as a person working for a bank, it seems to me that economists made a terrible mistake over the last few years. We focused on these wonderful mathematical models, beautiful things, but in many ways completely removed from the real world. We pretended we could work out what was going to happen on the basis of models built on data that extended back only, say, 10 or 20 years. And by doing so, we effectively excluded all the really interesting episodes in economic history, which could have enabled us to learn something about the risk of financial crises, the risk of hubris, the risk of policymakers losing the plot altogether. And so my plea, in one sense, is to say, well, beyond simply thinking about what went wrong during the crisis, we have to think much more carefully about economic history. Because without understanding economic history, we'll simply have more crises in the future. So on that cheerful note, I'll bring my comments to an end. Thank you very much indeed.
Thank you. So we now open the floor for questions. Can you please identify yourself prior to asking the question? If you don't ask, I will pick on somebody.
What about the possibility of distributed, collectively intelligent grids that are focusing more on renewables? So there still would be areas in which there would be tremendous growth as some of the old focuses on energy and food production and so on die back. So could it be that if we accept a lower ecological footprint and focus on some of these emerging systems that may have a different political economy than the current one, that we actually can fall back to places in which they're sustainable?
First of all, I think it's important to stress that despite my gloomy prognosis of the West, I think that technology can still play an extraordinarily important role. There are some economists like Robert Gordon who argue that we're finished with economic growth altogether because there's an absence of further technological progress. And I think that's wrong, partly because I think that we as economists are not very good at spotting new technologies. We can point to bad things happening. We're not so good at spotting the good things, which is why we're always known as the dismal science, I suppose. And perhaps I'm guilty of that. What I'd like to argue, however, is that the golden age of growth that the West went through, which I sort of demonstrated through my comments about my own life so far, was very much dependent on a series of one-offs that I don't think can continue quite so easily in the 21st century. One-offs which effectively led to a sudden improvement in the allocation of resources globally. So the first of these is the opening up of world trade, where I think there are still some opportunities, particularly actually on the south-south basis from Asia and the Middle East through to sub-Saharan Africa and Latin America. But from the point of view of the Western world, most of those benefits really happened between the 1950s and the end of the 20th century. Secondly, and very importantly, the role of women in the workforce. Go back to the 1950s, very few women actually employed, now a huge number employed. So a one-off increase in the quality and the quantity of labour supply, which was a fundamental change. Third aspect, education. Huge increase in the number of people going to university, coming out with degrees, being much better qualified, another one-off step change. And the fourth is consumer credit, which also has expanded hugely. My point about this is that this was a kind of one-off change, a series of one-off changes in the Western economies over the last 40 or 50 years, which explains why growth was so unusually strong. But I don't think they can easily last into the future. Then as far as the effects on, I mean, in one sense, I think your point in one sense is almost like a Malthusian point, that there's a risk that we're going to run out of certain things, or they become more expensive, or they're damaging to the environment, which is all perfectly reasonable to say. But I do think that one aspect of this, which I think is important to stress, is that there have been changes in technology which, importantly, have allowed us to in effect produce more outputs from given inputs. We've become better at producing, there's been a huge change in productivity over the course of the last 200 years. And I think that's something which doesn't necessarily end now. I mean, it can continue. But the problem, I think, currently, globally, is that the growth that we've seen over the last 20 or 30 years is not purely a technology-enhancing growth story. It's what I call growth associated with technology replication. And the problem with technology replication is that it tends to be a growth story which uses more and more of the world's scarce resources. And the reason for this is that up until the 1970s, 1980s, most of the growth we saw in the world was very much driven by the Western economies through this continuous advance of technology. The majority of the rest of the world could not get access to these technologies for one reason or another. That's changed enormously over the last 20 or 30 years. And one way to demonstrate this is through passenger air travel. If you look at the cost in terms of resources used per passenger mile of flying people around the world, the cost has fallen dramatically. It's much cheaper in terms of resource intensity to fly people around the world now than was the case previously. Unfortunately, the number of passengers flying around the world has gone up so dramatically that actually the total amount of resource being used is greater than was the case 50 or 60 years ago. So part of the problem is that we've gone from a world whereby the privileged West had the access to all the new technologies and no one else really had access to those technologies, to a world whereby many countries now have access to similar technologies, which has led to a huge increase in, for example, commercial flights in, say, China. A huge change over the course of the last 20 or 30 years. And so I think one of the challenges here is simply that as a consequence of this technology replication, we've gone back to a more Malthusian world than seemed likely at any point in the post-war period. So for me, that's something which is a worry, and does put more emphasis on using technologies to find ways of actually conserving on resources rather than simply using more of them.
Can you identify yourself before asking the question? Please, you have to press the white button. There you go.
We specialize in global macro investment. I fully agree that the credit expansion cannot go on forever. However, we also see some bullish signs in the Western economy, especially US. First is that although the baby boomer is going to retire, but we also have another baby booming and for the baby born after 1990s. So that's a huge growth too, because they are right now is 23 years old, but they're going to enter the market to find jobs, buy houses, something like that. Also, Jim Rogers says that US cannot get out of this unless we're so lucky like UK discovered the North Sea. And it looks like we do discover the North Sea, which is the shale gas revolution, which give us much better price, the energy benefit, the price benefits than, say, Europe and China. Also, we do see some disruptive technology going on, such as 3D printing, robot technology, which is around the corner. Also, another one is new material, lots of new material and cloud computing. That's all improve productivity, which is also benefit for the Western world. So my question is, I consider myself a confused economist because I do see some very bearish sides, such as US, we said, Mark Faber says 50% of Americans vote for a living. So we do have major problems. But also we see some bullish signs. So I'm confused. I want your opinion for that. Thank you.
Well, first of all, I think a confused economist is an honest economist. Anyone who's not confused is not really being truthful. I'm certainly confused as well from time to time. Let me just take each of those themes. First of all, the boomers, you're absolutely right, there's been a significant change over the last few years, and certainly the US, from a demographic point of view, has advantages compared with countries in Europe, for example, or indeed Japan. It's worth stressing here that the countries that are really going to start shrinking in terms of size of population, most obviously include Japan, but also include Germany, Italy, Russia, the Ukraine, but not the US. So there are some differences from that point of view. But having said that, what is, I think, intriguing about young Americans at the moment is that many of them are maybe leaving college or whatever and not finding jobs. And there's, I think, a significant danger of a kind of lost generation coming through. And one striking feature of the unemployment numbers in the US currently is the increase in long-term unemployed, which is really quite phenomenal relative to the older US story. And within the long-term unemployed, those who are long-term unemployed who are relatively young, many of whom are now coming off the workforce altogether, so sort of disenfranchised workers who simply have given up looking for work altogether. So I think there is a danger of some kind of lost generation. They certainly want work, but they can't find it. Secondly, on North Sea and shale gas, well, I'm old enough to remember the sort of North Sea revolution, and in many ways it was a very destructive revolution. Yeah, well, I don't think it did. I think it created more troubles than perhaps was expected, because the way it worked was effectively a Dutch disease kind of effect, namely that it was clear that more investment had to go into the North Sea, but that investment primarily came not just from within the UK, but from many international companies who wanted to be in the UK, so they all piled into the UK. And by putting investment into the UK, they pushed up the exchange rate quite significantly. And the rise in the exchange rate was a mechanism by which the UK would switch into North Sea production and away from manufacturing. But North Sea production actually involved very few people, and manufacturing involved a lot of people. So for a number of years in the UK, you had what was in effect a kind of wasteland created in many parts of the manufacturing industries, where lots of people lost their jobs. I would argue that the one country that's really benefited from North Sea oil in Europe actually isn't the UK, it's Norway. But Norway is tiny, and Norway was able to use its North Sea oil revenues to invest in assets all over the world, which I don't think is the comparison one would make necessarily for the US. So I think the other thing I'd just briefly say on this is that if the energy revolution is really that great in the US, it won't be confined to benefit the US alone. It'll have an impact on other parts of the world, because oil and gas will become increasingly tradable. The logistics will be constructed to make sure it can be sold elsewhere in the world. And then the question is, who is the biggest marginal beneficiary of lower global energy prices as a consequence of that? I'm not convinced it's necessarily the US. It may well be China, for example, that could be a bigger beneficiary in the years ahead.
Want to be independence, like energy independence, because of the shale gas, and also they may be a net exporter.
Well, the net export thing should certainly work, but being an exporter simply implies that the benefits then accrue to other countries as well. The price of energy falls not just in the US, but in many other countries too. So being an energy producer in the world of falling energy prices actually is not such a good place to be after all. It's the energy consumer that benefits from that rather than the energy producer. So I'm just a little bit skeptical about the full impact of that on the economy. As for 3D printing and all sorts of new materials, yes, I'm no problem with that at all, but I'd come back to an observation that was made in the late 1990s, and it goes back to some of the comments that Alan Greenspan made in the 1990s. In 1996, he talked about irrational exuberance, this sense that somehow the economy could not deliver the productivity gains that were being assumed. By 2000, early 2000, he was a convert to the new economy. You could now explain the gains in asset prices as a consequence of the new economy. The new economy has proven to be remarkably short-lived in the sense that by the end of the 1990s, people were beginning to assume that the US could grow at between 3.5% and 4% a year forevermore. The actual growth rate between 2000 and 2007, so before the financial crisis, was only 2.5%. So the actual growth rate a lot lower than the growth rate that was proposed on the basis of wonderful new technologies. So all my point is, I'm not disputing the technologies, I'm just having doubts about whether they in themselves can explain fully the kinds of growth rates that people would like to see in the future, and that's where I have significant doubts.
Thank you. Next question. Everything. Joy Deep. Yes, over here. Go ahead. You just have to get closer to the microphone. Oh, and you have one too? Oh, go. You can go first and then over there. The lady first and then the gentleman.
Hi, I'm Radhika and I work for Barclays. Just a quick question on what do you think the effect of being in war greater than 2 world wars put together was on the landscape?
So what I think, I missed, the question was the effect of 2 world wars.
What do you think the US, the impact of being in a 10-year war over a decade?
Oh, this last decade, you mean?
Yeah. What do you think that played on our economy?
That's quite a tricky question because there are different views as to the impact of wars on economic growth. There are some Keynesians, like for example Paul Krugman, who would argue that the Second World War was, from an economic point of view, something that helped to gain full employment. I find that a slightly odd argument in one sense, because you think, well, that suggests that war is a good thing in terms of sorting your economy out. There are others who might argue that war is a period whereby technological advance is particularly rapid for various military reasons, and that has trickle-down effects into the economy more broadly. I personally think that the experience of the last 10 years, if anything, is likely to have meant that the growth rate's been a little bit lower than might otherwise have been the case, as a consequence of resources being allocated elsewhere in the world rather than in the US itself, and resources that could be used for peacetime activity being used for military investments of one sort or another. But I'd struggle to put a particular number on it. So I think it's very difficult to work out precisely what the impact might have been. I'm aware that others have made their own calculations, but I don't think it's necessarily something which is central to my particular case, because of course the growth rates, the shortfalls that I'm witnessing or observing are not specific to the US. They're also true of many European countries as well, not all of whom were involved in sort of warfare over the last 10 years. The UK was to a certain degree, but I don't think that the numbers would be dominated by the military conflict itself.
You just have to get closer to the microphone.
Hi, my name is James Stranko, and I'm a consultant for the Clinton Global Initiative. My question is about Brazil. I guess since we're here at the American Society, it's relevant to speak about. When you mentioned Adam Smith's sort of states of the economy, you almost feel like Brazil within a few years' time has sort of gone through all of them, and now you're seeing a sort of sense that the marvel and sort of the wonder of the economy and its dynamism is dying off, or at least not being what expectations were in the past. And I just wanted to see if you could comment on how you see Brazil in the next few years.
Well, first of all, I expect there are people in the audience who are much better able to talk about Brazil than I am. So I apologize in advance for the naivety of some of my comments. I think that the BRICS concept was always a slightly peculiar one. Of course, I would say this because I work for HSBC rather than Goldman Sachs. They're the guys who came up with it, so it's their fault rather than mine. My point about this, I think there are some really quite big differences between, say, China, India, Russia, and Brazil, and the idea that we should lump them all together and say that they're all going to grow quickly because they're all quite big and they're all emerging, I thought was always a bit of a peculiarity. The first thing to say in Brazil's case is that compared with, say, China and India, its living standards per capita are significantly higher. Its income inequality is very, very high, of course. So it's a different kind of structure to what exists in either China or India. The second factor is that despite its efforts to try to diversify into a wide range of different industries, I think that Brazil, rather similar perhaps to the UK all those years ago with energy and oil, is in danger continuously of succumbing to Dutch disease. In other words, it's a commodity producer. The interest that, for example, China has in Brazil is mostly associated with commodities and food and so on. And the consequence of that is that Brazil has become unusually dependent, perhaps, on the waxing and waning of the Chinese economy. So when China was doing very well, commodity prices were high, it seemed like a relatively straightforward win-win situation for Brazil. Over the last year and a half, as China has slowed down, commodity prices have fallen, the volume of demand for commodities perhaps has slowed as well. Brazil has been exposed as perhaps a country that, in terms of domestic fundamentals, wasn't quite so strong after all. One thing that I observe about Brazil, and it's not just true of Brazil, it's true of a number of different emerging economies, is that over the last few years, they presided over a sustained deterioration in their balance of payments positions. It didn't matter too much for a while, so long as there was a belief that, first of all, export revenues would eventually pick up because of China, and secondly, because it was relatively easy to fund current account deficits thanks to the generosity of American QE. But remove those two factors, create uncertainties about export revenues, and also create uncertainties about the funding of current account deficits, then suddenly an economy which looked robust has its kind of soft underbelly exposed. So that, I think, is in itself a problem. But beyond that, I think, and I'm really thinking about my colleagues in Brazil who've covered this as part of my team at HSBC. I think the other thing they would observe is that it is possible there's a shortage of highly educated workers in Brazil. So there's plenty of people in Brazil, but not enough of them who can perform some of the higher-end tasks that are important in terms of generating faster long-term productivity growth. So there's effectively an educational constraint that may limit growth over the course of the next few years. But I think that when you look around the world over the last 4 or 5 years, and perhaps as a consequence of QE-type policies and how they've thrown liquidity around the world, there's no doubt that emerging markets in general have seen big deteriorations in current account positions, balance of payments positions, and that has left them, I think, exposed in terms of what's happening currently, which is why the tapering story may be a bigger issue for the emerging world than it is perhaps for the US itself.
Hi, I'm Megan Fliegeman with the Regional Catastrophic Planning Grant Project, Homeland Security Project. And you'd mentioned infrastructure a couple of times. And I look at the infrastructure that is right now getting set up, especially post-disaster. And I look at how we are setting up systems that are similar to what already exists and has failed, and how we are applying so much money and funds into these projects to rebuild systems that are proven to fail in the current systems. So my fear is that we keep on putting all of these millions and millions of dollars into rebuilding infrastructures that we have shown won't improve. But you had also mentioned how improved logistics through our infrastructure will amplify the economy. So what are we really doing with our infrastructure rebuilding projects if we just rebuild as it is to get it done fast?
More haste, less speed, I suspect, is the answer to that one. There is a habit currently of saying just invest in infrastructure because no, it gives good returns. And of course, there's a short-term reason for this, which is that if you do those kinds of projects, they might create more jobs and therefore more votes, regardless of the fact that perhaps the social and financial returns on those projects may not be quite as large as one might hope to see. Or alternatively, they don't necessarily rule out some of the catastrophes that you've talked about. Looking back over the last few years, I'll give you two examples of, this is not associated with catastrophes, but it's rather about the dangers of infrastructure investment in general. Two examples. The first one is a country in Europe which has some of the most fantastic infrastructure you could possibly imagine, at least by European standards, actually by global standards. And this country had a massive surge in infrastructure spending from really the late 1980s through to maybe 2007, a really wonderful story. And you go today and you find that the rail system works incredibly well. The airports are very modern and very attractive by the standards, certainly of London Heathrow, which is a total dump, I have to say, in most cases. Actually, it is, yes, that's true. Anyway, this country looks wonderful, but indeed, of course, it's Spain. Spain has had tremendous infrastructure investment, but the economy itself has not been transformed in the way that perhaps had been expected. A second example I wanted to give is Japan, because Japan over the last 20 years has seen a lot of infrastructure investment, and actually in the book I use an example of a particular prefecture which has seen huge amounts of investment in all sorts of things that were largely unnecessary for that particular area. I won't go through the details of it, but the point about this is that it just so happened that the former Japanese Prime Minister happened to come from that particular area, and the money was spent in the area for all sorts of fairly obvious pork barrel reasons. But the point is that infrastructure sounds attractive. There are lots of reasons why you should do it, but I'm not sure if we necessarily have the right political checks and balances in place to make sure we're getting proper value for money. I mean, one of the big advantages of markets is that, and they go horribly wrong from time to time, but one thing they do is provide some kind of discipline, ask the right sorts of questions about whether money should be spent or not. The difficulty with putting infrastructure projects purely into the political arena is that you often find that the project ends up being very different from what was originally expected, often with significant overruns, and the social returns are much lower. I was talking to someone in Spain recently, and I was saying, well, given the huge amount of unemployment that exists in Spain, what's the way out of it? He said, well, people say we should invest in infrastructure, but we've got far more than we actually need currently, so what's the point of investing any more in infrastructure and in these circumstances? So it's a good political soundbite to invest in infrastructure, but I think the underlying problem with it always is, can you be sure that you're getting the right kind of return, and can you be sure that you understand what the motive is for that particular infrastructure investment?
Edward Newberg. You went back to the 14th century, I think, you mentioned in your analysis. Yes. Did you find any positive examples where things were resolved, or did they all end up in sort of turmoil, or a more common term, train wrecks?
Well, of course, you might say I was being selective about my examples, which is always a danger with any kind of broad sweep of history. But I was particularly focused on the idea of economies slowing down and then working out thereafter how they coped with the disappointment relative to the earlier expectations. And actually, an example of success, it may not be successful forever, but I think an example of success politically and socially is Japan. Because despite the fact that Japan has delivered very little growth and has seen a tremendous loss for equity investors over the last 20 years, has seen a very substantial increase in government debt, the society as a whole was held together very, very well. Living standards haven't risen particularly quickly, but they have risen to a degree. The deflation that Japan's been through is not the kind of nasty debt deflation that the US went through in the 1930s. It's been a very steady, creeping process of very gradual deflation. So although Japan has fallen behind relative to its own history and also relative to its peers, in terms of the stability of Japanese society, it's held together really very well. And I would argue that part of the reason for this is that the Japanese felt, whether rightly or wrongly, that they genuinely were all in this together, to coin a phrase that George Osborne, the Chancellor of the Exchequer in Britain, used a few years back. It was funny that he used it because he's actually a very rich man indeed, but he felt that we were all in this together. And so Japan, I think, had the advantage of starting off with a relatively low level of income inequality, and a sense that people across society as a whole had to make sacrifices or had to accept that things weren't going to be quite so easy in the future, and they coped really rather well with that. The examples where things tend to go wrong are where societies are often unequal. As a consequence of the inequality, when things go wrong, there's a kind of blame game that comes through extremely quickly. And that blame game is kind of understandable, given that there's a gap between rich and poor, between the haves and the have-nots. It may be that the blame is completely inappropriate or unfair, but once it starts, it becomes very difficult to stop. So with the Peasants' Revolt, it was a very, very early example, oddly enough, of a change in economic circumstances that have been rather unexpected, where the society as a whole just couldn't cope with those changed economic circumstances. And for those of you who are interested, this is a slight digression, it all kicked off with the Black Death back in the 1340s, which wiped out a large number of people of working age in England, as indeed did across the whole of Europe. That naturally meant that there should be a significant increase in the wages of people of working age, because of course they were in short supply. But the feudal lords who ran the country did not want to pay the higher wages. So they passed, in effect, an incomes policy in 1351 called the Statute of Labourers, designed to make sure that the workers would not get any higher wages, had to work harder and harder, but there were no higher wages. So a little bit like the kind of austerity that you see in Spain or Greece today, same kind of theme that begins to come through from this. And one reason why the feudal lords did not want to make any sacrifices was because they were intent on preserving a particular area of public spending themselves, which in those days, of course, was warfare. That's all that people spent their money on. And this was at the beginning of the 100 Years' War against the French. The Peasants' Revolt was actually a consequence of the imposition in the late 1370s of a series of poll taxes, that the revenue was continuously running short. The way in which people avoided paying their taxes was to pretend they didn't exist, so they didn't reveal themselves for the census, so a whole bunch of sort of tax collection issues that, again, we hear today quite a lot. And eventually, the Plantagenet equivalent of men with baseball bats were sent in to get the money off the peasants and the workers. This did not go down very well, hence the Peasants' Revolt. But the point about the story is that the world had changed, but the political systems were unable to change with it, which then led to the kind of political crisis. And many of the examples through history are examples whereby the world had changed. Economic circumstances had deteriorated for one reason or another, and politically and socially there was no ability to cope with that change, or the wrong decisions were made in one way or another. So another example of this is that when people demand that Southern European countries deliver austerity year after year after year, we have a very good example in the 20th century of what happens when you try to do that. It's actually the UK in the late 1920s. The UK rejoined the gold standard, which of course was all the rage in the early 20th century, at an inappropriately high exchange rate, so it was uncompetitive, just as Spain or Greece is uncompetitive today. And there were years and years and years of austerity that lasted up until 1931. And this was the beginnings of the Great Depression. The UK was in trouble like every other country was in trouble. And the UK government decided to deliver an amazingly tough budget in September of that year. I mean, incredibly tough. And it was designed to make sure that Britain stayed on the gold standard. The British were determined to show that they would always look after their foreign creditors. They were always a trustworthy country. So the question is, September the 11th, 1931, the new budget came through, very, very tough, designed to keep Britain on the gold standard. A day later, the Times of London wrote up the budget in a very, very favourable light. It was a fantastic budget. It showed that the government was determined to keep Britain on the gold standard. Sterling was now safe. 10 days later, Britain was off the gold standard. The question is, what happened in those 10 days? How on earth did the whole strategy fall apart within such a short space of time? And the answer is, I didn't know this when I was starting writing the book, but in the research I did, I recognized this as the case. The answer is what was called the Invergordon Mutiny, which was a rebellious act by Royal Navy sailors who returned to port in Invergordon in Scotland a couple of days after the budget had been passed. They picked up their newspapers and discovered that they would have to take pay cuts of between 10 and 25%. They weren't very happy. So a combination, I think, of lots of rum and these huge pay cuts led to the mutiny. And once the military are mutinying, you basically lost the political argument. And that's when sterling came off the gold standard. So my point about this is that this is another example of where the old rules were based on a view of the world that effectively was no longer valid. It's one reason why I think in the Eurozone there are still huge hurdles to jump over, because in the Eurozone, there's a system that was built which was kind of half finished in one sense, but no one ever expected a financial crisis of the scale that we've seen over the course of the last 3 or 4 years. And that financial crisis has exposed some of the fundamental weaknesses in the system which have yet to be resolved. And it's very easy for the Northern Europeans to insist that the Southern Europeans should deliver austerity year after year after year. But looking at the experience of the UK in the 20s and early 30s, it's actually very difficult politically to sustain that kind of policy forever. And what it suggests ultimately is that there'll be a shift in the burden away from the debtors of Southern Europe towards the creditors of Northern Europe. The question is, how will that happen? And there are lots of different outcomes that one could imagine to deliver that particular eventuality.
We have one more question. Yes, go ahead.
Hi, I'm Lily. I'm a student. Just curious about, since right now it's basically fiscal repression, we know that it's a consensus that the governments are going to keep printing monies and devaluing their currencies. Where would you recommend to allocate assets in terms of, and you also address a little bit about the risk of hyperinflation or even actual defaulting happening? Thank you.
Okay. When you have a debt crisis, there are various ways out of it. The first is to default. The second is to create lots of inflation. The third is to devalue. And the fourth is what I call the theological option, which is you pray for a strong recovery. Unfortunately, the prayers haven't really been answered very well so far, so you're left with a number of difficult choices. One of the reasons why people talk about currency wars currently is precisely because in our international capital markets today, countries like the US have borrowed very heavily from countries like, say, China. And if the dollar falls significantly against the RMB, then the value of the US treasuries purchased by the Chinese will be now worth a lot less in RMB terms, even if they're worth the same in dollar terms. So it's one mechanism to try to shift the burden from one country to another. I personally feel that if the story is right about sort of lower growth rates, that even with these tricky times currently with the possibility of tapering and higher bond yields in the short term, I wonder whether, as people recognize that growth isn't that exciting, that bond yields will come back down again, and that people will switch out of riskier assets like equities into fixed income assets, partly because of aging populations, but partly because if growth really is that much softer, then it's difficult to see how risky assets can sustain the levels that they've reached over the course of the last few years. So in one sense, the kind of QE-type policies have created a gap between financial hope and economic reality, and either the economies improve very, very strongly indeed, or the financial hope has to erode to a degree. As for hyperinflation, for the most part, I don't think QE threatens that, partly because banking systems are so weak at the moment that it's difficult to see how printing of money, narrow money, if you like, creates a lot of broad money. It doesn't really have much of an impact in terms of the expansion of bank lending, the kind of might have seen in the past. So a hyperinflation risk, I think, is associated with countries that completely undermine their central banks for short-term political purposes. And in the developed world, the country that could be at risk of this, and it's a very small could be, it's a very unlikely scenario, but where I'd say it is more likely than others, it's going to be an odd country to choose, actually. It's Japan. But the reason for saying this is that Japan has a lot of government debt. It's got a government currently that's desperate for much faster growth, and its own political credibility depends on achieving that faster growth. It has used what you might describe as conventional, unconventional policies. And the issue, I think, is this. If those conventional, unconventional policies don't work, if in a year's time we discover that Japan isn't growing very quickly, what's the next alternative? Does Abe say, well, I promised a lot but couldn't deliver, which is particularly embarrassing? Or does he then demand much more in the way of unconventional policies, if I can call them that? Basically means launching monetary helicopters. In other words, that you'd have to have a big further expansion of the budget deficit, which is funded by the Ministry of Finance telling the Bank of Japan to print a lot more money to fund that big deficit expansion. And the tricky thing with this, I think, is that faced with that kind of decision, the yen would be in danger of collapsing on the foreign exchanges. But equally, if the yen were to collapse on the foreign exchanges, it might then lead to a panic amongst Japanese households about whether the yen really is worth anything at all. They get rid of the yen as fast as possible. Of course, if everyone does that, the value of the yen falls very quickly. In other words, the prices rise very quickly. And before you know it, you've got a hyperinflation on your hands. Now, I have to say, this is very, very unlikely. But I would stress this, that no one ever plans for a hyperinflation. They happen because of a complete loss of confidence in the financial system. And that, I think, is one of the extreme, unlikely but possible dangers associated with this desperate search for faster growth, using macro policies that actually are not the reason why growth was weak in the first place.
With that, we have run out of time. Thank you very much for being with us here today, Stephen, and we wish you lots of luck on your book tour. And it has been a fascinating conversation and witty, and I encourage everybody to buy the book because it's terrific. Great for warm summer reading. Thank you again.
Thank you.